In this tutorial, we're going to talk about money management and touch upon briefly some of the key differences between money management and the risk of a trading strategy. The reason for the emphasis is that traders often tend to use these terms, money management and risk, interchangeably in industry when they mean entirely different things. And let's demonstrate all of this with the help of a few examples. To understand money management, let's go through this example. Say we have a trader, and this trader has some starting equity, some starting capital to the tune of $2,000 US. The trader has a simplistic trading strategy that targets only one asset, and in this case, that asset is the euro dollar. Each time this trader takes on a trade to the market, the trader sets a fixed lot size of 0.1 on each of those trades. And to curtail any runaway losses or to simply predetermine maximum loss on any given trade should the trade go bad, based on some affordability or risk rationale, the trader sets a monetary constraint in the form of a stop loss. And this stop loss in this example will set to 40 pips, which means that in the advent of a losing trade, the trader stands to lose 40 times $1 per pip when trading at 0.1 lots on the euro dollar, or minus $40 as the maximum loss possibly experienced on any given trade in the absence of transaction costs such as spreads, swaps, and commissions. So what we've just described here, this whole configuration, is an example of money management whereby the trader is setting monetary values in both in terms of exposure to the market as well as maximum loss that the trader is willing to entertain. However, this configuration gives us no indication of what the actual risk is that the trader is assuming when going to market. And let's look at this in the following way. Let's imagine that with exactly the same specification here, trading the euro dollar 0.1 lots per trade, max loss of 40 pips, the trader has two distinct sub-strategies that use the same algorithm. In one of those, the trader trades 10 times a month in any given month, and in the other, the trader trades 100 times in any given month. Based purely on the frequency of these modes of operation being different, the risk of this trading strategy will also change, because with 100 executions per month, you're obviously going to incur a lot more opportunities to incur losses than would be the case when you're taking on only 10 trades per month. Additionally, in terms of assessing max loss events, let's imagine this trader has gone through historically in the backtesting and found that in either of those two cases, the maximum consecutive losing streak is 5 trades. Max losing streak. In either of those cases is 5, which means that having set a predetermined maximum potential loss of 40 per trade that the trader is willing to absorb, this would mean that in the advent of a max losing streak, the trader would stand to lose 5 times minus 40, or minus $200 would be the trader's loss on such a losing streak, the max loss event, which is roughly 10% of the trader's starting capital. If this trader is looking to attract investor capital, then this information is not sufficient for the purposes of a qualified investor. Why? Because the qualified investor isn't just interested in the magnitude of the loss, a maximum loss event that the investor could experience if investing in your trading strategy. The investor is also critically interested in the probability of such a max loss event happening, as well as a fixed time horizon over which the investor could experience such a max loss event, or within which that max loss could be exceeded. Simply having these monetary figures and discrete valuations in terms of losing streaks are not sufficient from the purposes of investor. And in the context of this example, were you to tell the investor that my max loss streak is 5, which resulted in a loss of 10% of my starting capital at a loss of $200 per losing streak in either of those two cases, from an investor's perspective, what's going on is that in the first sub-strategy where you're only trading 10 times a month, the probability of you experiencing 5 losing trades, which is a 50% losing rate, that probability is a lot lower than you experiencing a losing streak of 5 or 5% losing rate when you're trading 100 trades a month. Therefore, the risk to the investor of investing in sub-strategy 2 would be different to the risk that the investor would take on from investing in sub-strategy 1, purely on the basis of frequencies being different and therefore changing the probabilities with which those max loss events could happen. Therefore, having said all of this, it is always important to distinguish between money management and risk, regardless of whether you're looking to attract investor capital. As a trader yourself, it's a good practice to understand the actual risk you're assuming when taking trades to market. Additionally, having said all of this, to maintain a stable risk profile is also something that's imperative if you're looking to attract investor capital. It is impossible to maintain a stable risk profile in the absence of money management. If you don't use stop losses, if you rely completely on the volatilities of the instruments that you're trading over erratic durations or whatever defined durations you have without any capital management in place, you are at the mercy of the market more than you are at the mercy of your own capital management rationale or risk management rationale. Therefore, it's imperative that in order to maintain a stable risk profile, capital management be in place. In future tutorials, we'll discuss in a lot more depth the concepts of risk, how it's measured in industry, how we measure it at Darwinex, why we measure it differently to what is the norm in industry, and further calculations and concepts to that effect. See you in the next tutorial.